In my last video, I talked about the obstacles I had to overcome, and I walked you through the steps that both me and my wife have taken to put our family on a path to building wealth, starting from poverty. And part of that financial plan is a 529. And a 529 can be an excellent resource for preparing for your child's future. And we're going to dissect that and more in this video, so stay tuned. What's up, my people, and welcome to the channel. My name is Diamond, and this is the place where personal finance intersects with the real world to help you achieve your financial goals. And real quick, before we dissect 529s and talk about the ins and outs, I want to take just a moment and thank the 10,000 people who subscribe to my channel. As you can see, we got a little celebration going back there. I just want to take this time out and say thank you. And this number is nice and all, but what I'm really proud of and what really excites me is what I see going on in the comment section. It's really a community that is growing of like-minded people helping each other learn and grow together. And that's what keeps me going. Now let's dive into 529s and explain exactly what they are. A 529 is a tax-deferred account that allows you to save for your kids' higher education. And no, it's no longer just for college. A 529 can be used to pay for not only college, tuition, books, and fees, but it also can be used to pay for K-12 private school, up to $10,000 a year per child. You can also repay student loans up to $10,000. And what got me most excited is now you can use it to pay for apprenticeship programs and the associated costs that go along with those programs. And if you're not up to date on an apprenticeship program, it's basically trade and vocational schools. And you should check out apprenticeship.gov and see exactly what they have to offer. And whenever you hear tax deferred, I want you to get a little excited inside, because what that means is you get to take after-tax dollars, put it in an account, invest it. That money will grow at the rate of your investments. And when you spend it on those qualified expenses, it also comes out tax-free, which is a good thing. Another cool thing about a 529 is that the person who opens the account is the owner and you get the name of beneficiary. So if I'm opening an account for my child and I name them as the beneficiary, the account is actually mine, which is going to play an important role on how it's going to impact financial aid down the road, which we're going to get into later in this video, so stay tuned. The 529 is a state-run program, which means each state is going to offer their own variation of a 529. But you're most likely going to run into two options within the 529. The first one is prepaid college tuition. With this one, you're going to lock in the cost of college today and pay for it in one lump sum, or you're going to spread those payments out over so many years. But with this plan, your ROI, or return on investment, is going to be equal to the inflation rate of college. So if you lock in the price today at $30,000 for a 4-year degree, and 20 years from today is $400,000, well, that $30,000 you paid covers you. Now, you have to be careful with this plan and make sure that you're reading the fine print, because the school that your child may want to go to may or may not be part of that program. Or what happens if they want to go out of state? Some plans you can transfer to other schools, others you can't. So this is going to be state specific, so you want to read the details on that. The second option you're likely to come across is a savings plan. And this is my favorite and what we chose to set up for our child. With this one, you get to choose your investments. And when it's time to withdraw the money to use it for those qualified expenses, you're not locked into a particular school or set of schools, nor are you locked into a particular state. And unlike prepaid college tuition, your rate of return on your investment is not going to be equal to the rate of inflation. You can invest it in the market and your rate of return will be equal to that of the market. And to me, that's appealing. And if you're not a stock picking guru, don't worry. A 529 savings plan is going to be similar to a 401k in that it has a predefined list of options for you to choose from. So within this list, you're going to have mutual funds that track a variety of indexes that's going to allow you to invest in both securities and bonds. And if that still looks like it's too much for you and you're like, hey, Diamond, I just want to open this account, put some money in it, and let it go, then you can do that, because you also are going to have portfolios pre-built for you where you can choose either your child's age or the year they graduate. And then from there, the company you're investing with is going to adjust your portfolio as your child get closer to graduation. And what's happening is when your child is young, the account will be moderately aggressive or aggressive as they call it. And then as they get older, it'll get more and more conservative to protect your investment. One thing to consider is that some states do offer a tax break for opening a 529 within the state you reside in. So when you're doing your research, you definitely want to take a look at the tax breaks if any are applicable to you. Some other things that I looked for when I was opening my 529 was the investment options. What can I actually invest in? And do your research on those particular options to make sure that they're good, solid investments, because that is going to have a direct impact on how this account is going to grow over time. The next thing is fees. You want to see what type of fees are associated with opening the account, what is the minimum that you need to open the account, and on the investments themselves, you want to see what fees are associated with those. And those are called your expense ratios. When you combine the investment options with fees and tax breaks, only then will you know that you're making the right decision for your 529. If you move, check your new state law, because you can roll a 529 from one state to another, and the new state may offer a benefit that the old one didn't, and it could be worth switching, so it's something to look into. If you're getting value out of this video, give me a thumbs up, hit the like button, and let me know. And now let's talk about how do you get money in a 529. As of this recording in 2021, there's no income contribution limits for a 529, which means regardless of how much money you make, you can open and fund a 529. To actually get the money in the account, you can set up automatic reoccurring monthly deposits, or you can make lump sum deposits. And each year you can contribute up to $15,000 if you're single, $30,000 if you're married, without triggering gift tax or affecting your lifetime estate exemptions, which is for all my 8-figure net worth families out there. In fact, there's a rule that allow you to basically super fund a 529. And what this allow you to do is put in 5 years worth of gift exemptions in a 529 at one time. So if you're single, that's $75,000. And if you're married, that's $150,000 that you can put into a 529 at one time without triggering gift tax. And now is the perfect time for me to tell you to always seek professional tax advice, which is not me, because the rules can change from year to year, from state to state, and everybody's situation is different. So you want to make sure you seek professional advice so you don't get in trouble with the man. And here's a pretty unique way that you can fund a 529, and that is with a gift code. And a gift code is a unique code that's created for your account that you can give to family, friends, or strangers, and that will allow them to put money in your child's 529 without knowing all the account details like the account number or balance or anything like that. Think of it like a Cash App username or a phone number that you would send money to using Zelle or one of the other many money transfer platforms. You can do the same thing for your child's 529. And if you want, you can send money and fund my child's 529. Just joking, not joking. But in all seriousness, here's some unique ways you can use this code. May 29th is National 529 Day. 529, get it? I didn't make it up. And also, September is National Save for College Month. These are appropriate times to share this code and a unique way to fund your child's 529. And 529s do have a maximum account balance, which is going to range between $300,000 and $500,000, again, depending on your state. So definitely check your state laws. But what's cool about this is if you hit that peak, you can no longer add money to the 529, but the money that's in there will stay invested and it will continue to accumulate over time. And there is no limit on how long a person can have a 529, which means your child at 80 years old could still have a 529 that's growing interest. Which brings me to my next point. And this account most likely won't make it till your child is 80 because they never used the money. And the reason for that is simple. When I opened the account for my child, I'm the account owner. I listed him as the beneficiary. But I can change the beneficiary. You have to remember, you are in control of this account. And you can change this beneficiary to a family member. And that family member that you list is now the person who is authorized to use this money for qualified expenses. And the IRS defines a family member as the following: your children, your siblings, parents, step-parents, nieces, nephews, aunties, uncles, in-laws, spouses of any of the previously mentioned, and first cousins. So as you can see, there's a long list of people who you can list as the beneficiary. So somebody's going to use this money. And one thing to note is that you can only have one beneficiary on the account at one time. So if you have multiple kids, you most likely want to open up separate 529s for each. That way, if they both need the money at the same time, they both have access because they're listed as a beneficiary on their particular account. At this point, a valid question would be, what can you use this money for? And what type of impact is it going to have on future financial aid? And those are good questions. And I keep referencing qualified expenses. And that's because when you read the tax code, it says qualified expenses. And so for college, you have things like tuition, room and board, books, fees, computers, software, even internet access. But strict rules apply. So again, talk to your tax professional before you start pulling this money out and just buying whatever you think is a qualified expense. For example, even though you can buy computer software, the computer software has to be related to your studies. So if you're buying a computer and you need Microsoft Office, you probably can easily justify that that is a requirement of the college. But if you want to buy a new Call of Duty game, good luck convincing the IRS that it's required for your studies. As far as the impact it has on your financial aid, if the parent owns the account, it's considered an asset of the parent, meaning that 5.64% of the account balance will be counted towards the expected family contribution, which is the EFC. And the EFC is a formula they use based off the information you provided with your FAFSA application, and they use that to calculate what type of need-based assistance you may or may not qualify for. And if you want more information on the EFC formula, I'll leave a link down to it in the description box so you can go check it out in its entirety. Now let's say a grandparent opened the account. A grandparent was excited, opened an account for their grandchild, and they're the account owner. They list the child as the beneficiary. Well, that's going to have a different impact on your financial aid than if the parent opened the account. Because remember, for financial aid purposes, the money in a 529 is considered an asset of the account owner. And when you're filling out your FAFSA form, they only ask about the parent or guardian's information and the child's information. They don't include the grandparents. So if the grandparent opened the account and they own that account, then for FAFSA purposes, that account don't exist. So for year one, it won't be taken into consideration. But here's the caveat. If the grandparents take money out of that 529 to pay for college, any money they take out of that account and use it towards that child's college, that following year, whatever they took out is going to be counted as income, and that's going to have a significantly higher impact on your financial aid for the following years. So it's something you want to watch out for. At this point, you may be wondering, what happens if your child don't go to college? What can you do with this money? And let me say, my child is 9 months old, and the truth is, we don't know what our child is going to do in 18 years, whether or not they're going to go to college. But the reason I decided to open this account and start funding it is because the thing that me and my wife has learned as we paid off our debt and got our retirement on track and got a little money around us, we've learned that having money, it just provides you with options. And with options, you have more power over the decisions you make in your life. And so for us, this 529 is just there to provide options for the child. Now, if the child is 18, 19 years old and decide, I don't want to go to school, that's not for me, then you could just leave the money alone. Because how many people do we know that decided at 18, 19, or 20 years old that they didn't want to go to school, only to turn around at 25 and decide they want to go back to school? So you could just leave it there, and then it's there if they change their mind. Because remember, there is no time limit on how long someone can have a 529. Another option you have is name a new beneficiary, which takes me back to that long list of eligible candidates, from your other children all the way down to in-laws and first cousins. Another option you have is you could roll some or all of it into another 529, because maybe your oldest child is saying they don't want to go to school. Meanwhile, the next child has a 529, but they need more money in it. So you could take money out of one, roll it into another, and that's an option. And the last option you have is to withdraw the money. Now, if you withdraw the money, there is going to be some fees and penalties associated with it. If you take this money out and you use it for non-qualified expenses, you can expect to pay a 10% penalty to the federal government. The amount you withdraw, minus your contributions, will be treated as income, so you can expect to pay your tax rate on that. And then you have to look at what's going to be taxed and any penalties that's going to happen at the state level. So you want to take a look at all of that before you make that final decision to just pull the money out. But all in all, you have a lot of options when it comes to 529s and how you can use the money. I know after I got married, one of our biggest expenses was my wife's master's degree. So had I had a 529, instead of us spending a year paying for her master's degree out of pocket and spending a whole year's worth of income, or one of our incomes, we could have used that 529 to pay for that college. So you might be saving for your future daughter-in-law or son-in-law's college degree, which may not be a bad investment either. And I want to leave you with this one final tip. I know when I had my first child, I was super excited, and you may be fired up as well, and you're ready to do right by them, and you want them to have the best life possible. But what I did, and I'd recommend the same thing to you, I would not fund a 529 if you have a lot of consumer debt, if your retirement is not on track and you're not saving enough for your retirement, or you don't have an emergency fund. You want to get those things out the way first before paying for your kid's college, because there's 100 ways for your kid to go to school, and we've already said they might not go to school at all, but you will definitely retire one day, and you don't want to have to depend on your kids to take care of you with their fancy degree when you don't have enough money to pay for your medication. So that's just a little tip from me. And if you want to learn about other ways to save for your kids' college or investing in general, you're in the right place. Be sure to click the subscribe button. And until next time, my name is Diamond. Peace.